What's up, guys? It's me, Alexander Jarvis from alexanderjarvis.com, and we'll be going through the marketplace financial model right now. Now, this is the fourth video, and in this, we're going to be covering 5 sheets. So we've got the 3 profit and loss pages. We'll briefly look at the depreciation and tax page, and then finally the P&L for deck, which is basically going to be 5 seconds long. So let's start out with the sheet which involves the most work from your side, which is the profit and loss or P&L actual sheet. Now, the first thing I want to do is to ungroup this all so you can see everything you need to fill in. Now, I alluded to this in one of the previous videos. I bucket everything into 3 packages in terms of forecasting or avatars. Basic, Premium, Pro. And so you can charge different amounts, or you can think about them as having different kinds of profiles. Maybe they convert at different rates, they pay certain amounts more money or less. However you want to think about how to better model averages of groups. And so you may have lower end customers who are not very profitable, but you need them for, say, liquidity. Whereas maybe it's the premium or pro customers, which you make the most money on, but perhaps there's fewer of them. Or maybe they cost more to acquire. I don't know. But depending on how you think about your business, you can forecast these differently. Now, it's more than likely that you probably don't track this data in your business intelligence analytics software. And so you may not be able to fill these out as in terms of your historics, in terms of basic, premium, pro. Maybe you can in the future, I don't know. At which point you'll just maybe fill it in, put all these into, so if we've got 30, we're going to put in 30 here, 50, 70, 115, 150, because this is then going to move into the P&L combined sheet. So if we look, ungroup these up, bear in mind these are all in the same rows. Sorry, we hide this. These all need to be on the same rows, right? Because the model somewhere is going to pull them off the same row. So if you start messing up with rows in some of these sheets, this is going to get confused, and computer says no. So we'll see 30, 50, 70. If you put these in line, they'll come in one. But once the actual, so we can see we've got conditional formatting here. So this is actual, this is forecast. If you got them all in one line, we'll just have this 150 here, and then we'll go down starting to 55, but you'll see the growth from 150 to 173 in the group. I would just maybe make a note of that when you explain it to investors or something, that you forecast on this basis, but actually your analytical software tracks it in aggregate, which is fine, so long as you have an explanation for everything. You can, of course, forecast a model with one avatar if you like, but generally having 3 makes better sense because you can think more and think about the details of how you want to target and build in more minutiae. Maybe before we get into the detail of this, why don't I explain what's happening here? So the model is very forecast orientated. That's what it's really about. The actuals, well, there's only 1 or 2 places where it's actually going to filter in. I think that's typically your customers, assuming that they're already going to roll in. You have more opportunity to make more money off that existing base. But otherwise, we're really preoccupied with the forecasting part. So there's 1 or 2 places where, say, your customers are going to roll into the forecast to add into them. But mainly your P&L actual is going to go into the combined sheet. The P&L forecast is the sheet where basically everything, your costs, your revenues are all going to get dumped into the P&L forecast sheet because they're the forecast. The P&L combined, it doesn't actually really matter at all. It just enables you to see the progression. So you can see here's our forecast, here's our actuals, how are they building off each other? You can see the growth rates keep on rolling approximately like they need to. And therefore, you know, depending on what your forecasts are, you can see that breaking point and say, well, oh God, well, we had some wonky piece of growth here and suddenly it starts growing a lot more. Is that realistic or not? Are my assumptions in line? That's all it is. The P&L combined basically just says, pull in my actuals here, then add my forecasts, and there are 36 months in this sheet. Okay, so back to the actuals. So supply side suppliers. So on your supply side, how many suppliers do you have? It's not the listings, it's the number of individuals. So you may have a supplier with 10 listings. It could be Uber and have someone who has 10 cars. Maybe that is just one supplier, but on listing side, you have 10 cars. It's a different concept. Demand side is people who take the Uber car, as opposed to the supply side of people who provide the driving. Or it could be, say, for eBay, If I want to sell my shoes, I'm a supplier. If you buy the shoes from me, you are a buyer, or you're on the demand side. So put in how many you have as well, up to date. And whenever you want to update this for adding another month, you're going to go into the formatting sheet and change this again, right? So back to the actuals. Then you have your transaction GMV. Now, I might touch on this in another video, but I may as well just raise it now, is you have to understand what goes into GMV and what doesn't. So if you charge non-transactional related fees, it could be something like, say, payments, those are not a function of your GMV. There's what I calculate as two parts. One is your transaction GMV plus your affiliate GMV, which could be coming through another channel. The other parts go into revenue. And so your GMV is purely transactional. So if I list shoes, you buy shoes, there you go. If you charge me some membership fee, that's not going to GMV. That might be consideration in terms of your calculations for, say, payment costs for payment processing. I'm taking it off the basis of net revenue after cancellations here. Depending on you may want to look into that, but I might cover that in a future video, because you'd have to understand what you're doing pretty in detail for you to understand that specifically. But bear in mind, transaction GMV is purely transactional gross merchandising value. And so you're going to have the number of transactions that occur to generate that revenue. Now, in terms of revenue, okay, this is going to be your gross revenue, and it's going to be how much revenue you're generating on the supply side and then on the demand side. Now, for marketing purposes, you have discounts and vouchers. Most people do it. Put in how much you're taking a loss in there, which will get you to your net revenue. You see your growth rates. If you have cancellation rates and your P&L forecast, this is going to be an average assumption, so you can look at what your typical cancellation rates are and keep that as a steady state number. Now we have the cost of goods sold, which is going to be staff, payment costs, server costs, email costs. So your staff COGS are going to be customer care, customer success, both on demand side and supply side. So you can aggregate both of them into here. Payment costs, server costs, email costs, tech costs, right? Tech costs are coming in a sheet somewhere over here, I think. So now that gets us to what a gross profit is. Now we want a paid marketing spend, so which is going to be demand and supply side, which could potentially come from the detailed sheets on the paid organic sheet. It's the paid part of that. Your offline marketing is going to be anything random which is not directly attributable. So I don't know, organizing booths. You don't really track exactly what's generated from it. It's just spend that you're going to do, which is not on Google, etc. So if you have any non-performance related marketing, it goes into the offline marketing. This is a line item which is in another sheet, which I can't remember at the top of my head, probably in the marketing sheet. After deducting this gets you to gross profit after marketing. The reason we specifically want to spell out that we have what the marketing is, because typically a lot of businesses, if they decrease their marketing spend, it will impact on their growth, but they potentially could become profitable because of that fact. And so this is something these smart investors and smart funders will understand, is how much they're investing into the future of the growth, which is especially the reason why normal Silicon Valley startups, especially the ones that IPO, are preoccupied with growth, because it's something investors care about. If you've got bad debt, credit card fraud, which pretty much everyone has, how much is that? Again, this is going to be assumption, which is going to be in a PL forecast sheet, which you're going to want to put in what you believe that's going to be on an ongoing basis. And so long as that number is reasonable, no one's really going to question on you too much. Unless, of course, you're a very large business, in which case they'll scrutinize pretty much everything. If you've got 7% credit card fraud debt, I mean, maybe you should be thinking about what you're doing and improving it. Now, you've got three main buckets for your operating expenses: G&A, R&D, S&M. So general administration, so general management, if you will, and office costs. R&D, which is building your product. S&M, sales and marketing, not the good kind. S&M shit, is all the people who do sales and marketing. But it is not your paid spend, okay? So this is your staff and then other attributable costs. That aggregates into your OPEX. When you deduct your OPEX from your gross profit before OPEX, you get to EBITDA, earnings before interest, tax, depreciation, amortization. I deal with tax and I deal with depreciation. The model amortization doesn't really matter for most startups, so I just don't put it in there. So this is going to be calculated from the DNA sheet, which we'll cover in this video. Income taxes only apply if you're profitable. I've got a fancy calculations which do all the thinking for you. When you make those deductions after EBIT, which is earnings before interest and tax, you get to your net income. And then we accumulate those losses over time to see how much you're burning there. Now we're going to make a differentiation between a profit and loss, which is, I tried basically followed an IFRS GAAP. I'm not going to profess this is 100% GAAP IFRS because there's probably things which I haven't thought about, which I don't frankly care about either. Never want to be an accountant. What you should really care about is the operating cash flow, which is money coming in, money coming out. And your year end is important because bonuses, tax, etc. are going to be paid out on your year end. So you will accrue them in your profit and loss, but you'll pay them out in the operating cash flow, which is why you need to be setting what your year end date is. So 8. So if it's December, it's going to be 12. Okay. So there's a couple numbers to put in here. I mean, we're going to take, what we basically do is make deductions and adjust, or additions and deductions based off your net income. So we're going to add back depreciation if you have it, make deductions for your capex. So if you've been spending tables, chairs, computers, however you define it, make deductions for that to date. So these are not going to be going into the OPEX bucket. If you've accruing bonuses for the year, you input the monthly amount. This will go into the staff sheet, and both the detailed and basic version will add in the accruals for this, and for the end of time period we'll make a deduction on the year end basis. So if you already paid out a bonus and these, so that's going to offset each other, you're done, it won't accrue. It's only this part it's going to accrue. So 4 months, we'll have 8 more months in the forecast period, and then they will be paid out in, I don't know, 8, wherever, in this bonus period here. See, annual bonus. So that's where it'll happen. So you pop these in. If you raise any money in your actuals, say $1 million here, fine. You put in when you fundraised. You do the same thing, the same line in the forecast sheet. Cool. Now, P&L forecast, it's a doozy compared to the actual sheet. So fine, look, if you have proper accounting, you track things, you'll figure out how to fill in all those numbers properly. Maybe just start with it roughly, but then, you know, if you're going to send this model to investors, you'd want to have them right because they're going to check, right? So there's only a few assumptions you have to put in. It's what do you believe your discounts and voucher rates are going to be, cancellations, bad debt, credit card fraud, and then you put when you're going to fundraise. So if you're going to fundraise at this time period and whatever O is 7 months out, $6 million, put it in thousands. Or maybe you can raise in the future, depends whatever it is you want to do. So bear in mind, these sheets are going to come in as thousands. The rest of the sheets are going to be nominal, so in the actual dollar amount typically. Now, P&L combined, there's literally nothing typing in. All it does is combine your actual periods here. You can see grace goes here, and then forecasts. That's it. Now, depreciation tax. So this is based off investment banking standards. If you don't know what you're doing, just ignore it. If you're a new company, then you don't have, you know, net ending capex from a previous period. You don't have nulls, net operating losses. You don't care. You probably not really want to getting into, you know, for your depreciation, what your basis of the tax life and the capital life and times declinings and whatever. If you're a CFO type and you care about this stuff, feel free. I, as an investor, wouldn't really care about this, especially because you're probably losing money, so who cares anyway? If you are a profitable company, you're planning to be, this will matter to you, but you'll understand what to do. This is literally what we'd use in investment banking, okay? So I'm not going to get into any more detail. Now, P&L for deck, I can make this a 5-second video. Do whatever you want to it. If you want to delete it, right-click, delete, or hide. I don't care, okay? If you have all these questions or whatever, I don't care. I'm not interested. I literally just made this as an example of something you could potentially put in a pitch deck or something brief you want to look at. You know, screenshot and send to someone, whatever. You can put whatever you want to have on these lines. Nothing is linked to it. Do whatever you want to this sheet. It says your input here because we got 6 months of actuals. I don't do the calculations for you for your actuals. I do it on your forecasts. So the reason why I had this guy code in your input is because if you're going to use it, you're going to type it in yourself and override the formulas. We've got annuals, we've got 12 months of actuals and forecasts. There we go. That's all it is. Apart from that, I don't really care. Now, guys, in the next video, I think we're going to deal with the source and use charts and KPIs together rather than splitting them up. So we'll cover that. As usual, if you've got any specific questions about this, hopefully this is actually pretty obvious. Feel free to hit me up with any questions. If you don't know how to be putting in actuals, it's kind of your problem. You need to figure out what your numbers are and put them in. And then when you compare them from your P&L actuals to your forecast, you can make sure that things broadly are lining up. There we go, guys. Keep hustling.